Corporate finance practice problem using OneNote. Financing option common stock problem 1. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're going to be in the icon on the left-hand side. We're in the practice problems area, and then down here in 1126, financing common stock prob 1. Also note that when using OneNote, take a look at the immersive reader. Our presentations up top will typically be mirrored down here in the text area, same name, same number. Transcripts down here, transcripts that can be translated into multiple different languages and either listened to or read in them, thereby being a good complement to the practice problems or presentations up top. Closing the icon, our information is up top. We'll do the calculations then on down below for them. Remember, we're keeping our mind in on financing of the company. How can we finance the company? Two main categories. We have the debt financing, which we've talked about in prior presentations, and the equity financing, where we are focusing now. When we think about the debt financing, we had to deal with the fact that the major thing we have to pay for is going to be interest on the debt. Interest is going to be taxable on the income statement. It's on the income statement and therefore taxable, and deductible possibly for taxes. And therefore, we have to counterbalance the tax impact as well as the cost of the financing if we want to compare it to something like financing with equity, where we do not have that issue with the tax impact. The major equity thing that we would be thinking of is the common stock. That's the first thing that would come to mind typically when we're thinking about financing through equity, basically giving some other people the shares giving them access basically to the company as an ownership interest in the company, rights then possibly to the earnings of the company to be distributed in the form of dividends as is going to be declared by the company, the dividend policy of the company, and also had a voting rights within the company as well. So we're issuing the common stock. Also note there's some differences between the bonds and the stocks in that if you're looking at bonds or some kind of debt financing, there's typically going to be some type of maturity date. When you're thinking about the common stock, then you don't really have that end basically date. You're going to have a similar kind of payments that could happen from the company, which in this case would be the dividends that would be going out as opposed to the interest payments when you're thinking about something like debt. But we also have to consider that there's the equity financing within the company. And so you can think about it, of course, if we think of the common stockholders as we do as owners of the company, the owners have the equity claim to the company. So from an accounting standpoint, if you rework the accounting equation as assets minus liabilities equals equity, then that kind of equity component, or the net value, assets minus liabilities equal the net value of the company, is part of what is owned in essence by the common stockholders. You can basically think of it that way as well. Therefore, we have to not only account for the dividends, which would kind of be like the cash flow impact, but also for the value of the stock. And we're assuming that it's going to go up, or the value of the company increasing, and thereby the value of the stock, the equity interest, increasing in a similar way. So it's a bit more confusing in that way. Note also the dividends could vary. They could change from year to year. So that can be a little bit more difficult than, say, the preferred stock, where you don't have the same kind of thought process that you have the ownership of the company, and the dividends are typically a bit more fixed there. So let's look at the information. We got the dividends per share, $2. We have the common stock price. This is what we're assuming we can sell it for. We will sell it on the market, so we're going to sell it for whatever we can get for it. But remember, this is a sale that's coming directly from the company. The proceeds then going to the company in this case, rather than a trade for stocks that are already on the market. The expected growth is going to be 12%. And then we're going to say there's a flotation cost of the $4. So we'll do this calculation a couple different ways. The first way we're going to call the cost of retained earnings, which we're going to say is the dividends divided by the common stock price that we're going to issue. We're going to do this first in the order of operations, and then add the growth rate to get the total cost. So let's see what that looks like if we put that into a table type of format. We're going to say in order to get the money is going to be the $40 per share. So in order to get that, we're going to have to pay $2. That $2 is going to be an annual thing, because we're going to assume that's going to be our annual dividend of the $2. So we're going to take the $2 over the 40. So 2 divided by 40 is going to give us our 5%. So that's going to be our 5%. Now, this would be, if there was nothing else involved here, this would kind of be our return, right? We would say, okay, if we're going to pay $2 annually and we're going to get the 40, then we're going to say 2 divided by 40, and that'll give us our 5% that we can then use. But we also have the situation where, and that would be kind of the cash, when you're thinking about the cash that's going out, we're thinking about the $2 that are going to be paid. But there's also going to be that equity interest growth aspect of this due to them being the owners of the company, and we're saying the growth is going to be 12%. So we're also going to say the 5% plus that 12% expected growth, and the 5 plus the 12, that's going to give us our 17%. So you'll note here there's no tax implications because the dividends are something that are going to be paid that are coming out of equity, balance sheet thing, not on the income statement, as opposed to interest, which would be on the income statement. But we have this added factor, which can be a little bit confusing for us to calculate, which would be the expected growth rate, in order to get a comparable rate, one that we can then kind of think about when we compare it to something like debt financing. Now, it's still not like a perfect comparison because, of course, the expected growth is going to be something that's going to be highly speculative. We got to think about, what's going to be the percentage ownership of the stocks that are going to be distributed as well. And we also note that the dividends could vary over time. Also, the dividends here are going to be something that could go on forever, considering the life of the company could, in theory, go on forever. Whereas if we're looking at debt financing, we typically have some maturity date. Even if they're 30-year bonds and whatnot, you would think there's some maturity date at some point in the future. So, of course, our goal here is to come up with something that we can do a comparison with. And so this is going to be a useful tool for us to do those types of comparisons. So now we can say, well, what about the flotation costs? We'll do a slight adjustment to this to take into consideration now the flotation cost. We got the same information. We're going to call it cost of common stock now as we add the flotation costs. The flotation cost is going to be the cost, like the one-time cost of us to issue the stock. You can call it floated. We're floating the stock out there, apparently. So it's kind of the executive cost for us to get the stocks out there. So we'll take that one-time cost into consideration. It's different than the dividends in that the dividends are something we expect to be perpetual into the future, right? We're going to be paying dividends into the future, whereas the flotation cost is a one-time cost. Therefore, we'll basically net it out against the price. So we're going to formula be looking something like this: dividends over the common stock price minus the flotation costs. Then we're going to add the growth rate. So this little calculation will have a sub-calculation in here taking care of that basically net sales price that we'll have. So what we have then is the dividends. We're going to have 3 columns now. I'll put the dividends in the middle column. So we got the dividends, and then we're going to compare that to the net price, not just the price at this time, which is going to be the net price, the common stock price, the $40 like we saw before, but then taking out the cost of the issuance, the one-time cost of the $4, the 40 minus the 4 is the 36. So now we're going to be comparing the dividends per share to the net price, which is 36 rather than the 40. 2 divided by the 36 is going to give us 5.56%. Then we're back to basically the same area. We're going to take that 5.56. We're going to add then the growth rate, which we're saying is the 12%. And that'll get us up to then the 17.56. So once again, similar kind of formula. We just got to take into consideration the flotation cost. Note that that is a one-time cost. Therefore, we're basically thinking that what we have received, even though we're selling for $40, is basically the net sales price, which means we're going to be getting the 36 in essence after that one-time cost. Then compare that to our dividends and then move forward in the same fashion as we did with the prior one.